At its core, a central bank digital currency, CBDC, is a digital form of a country's fiat currency, issued and regulated by the central bank. Unlike cryptocurrencies like Bitcoin, which operate on decentralized networks, CBDCs are fully controlled and backed by the government or central banking institutions. This centralized nature distinguishes CBDCs from cryptocurrencies and gives them a sense of stability and trust that is often associated with traditional forms of money. The concept of CBDCs gained significant traction after the success of Bitcoin and other cryptocurrencies. It prompted central banks worldwide to explore the potential of creating their digital currencies, adapting to the changing financial landscape. To understand how CBDCs work, we need to delve into the technology behind them. Most CBDCs rely on blockchain or distributed ledger technology to record and verify transactions. This secure and transparent infrastructure ensures the integrity of the currency and prevents counterfeiting or double spending. CBDCs can take two primary forms: retail CBDCs and wholesale CBDCs. Retail CBDCs are designed for public use, allowing individuals to hold and transact with digital currency directly. This means that consumers can have digital wallets provided by the central bank, mirroring the experience of physical cash transactions. On the other hand, wholesale CBDCs are geared toward financial institutions and are utilized for large-scale interbank settlements. These wholesale CBDCs streamline financial transactions between banks, improving efficiency and reducing settlement times. Central banks are exploring CBDCs for various reasons, driven by the potential advantages they offer to the financial system and the economy. One of the most compelling reasons for central banks to develop CBDCs is to address the issue of financial exclusion. CBDCs have the potential to reach unbanked and underbanked populations, providing them with access to secure and convenient financial services. By offering a digital currency that is easy to access and use, central banks can extend the benefits of the financial system to those who were previously excluded. CBDCs could also revolutionize cross-border transactions, making them faster, cheaper, and more accessible to businesses and individuals. The adoption of CBDCs could remove intermediaries and streamline the settlement process, leading to more efficient global transactions. CBDCs offer central banks new tools to implement monetary policy effectively. The ability to directly control the money supply and track transactions in real time could enhance the responsiveness of monetary policy to economic fluctuations. With CBDCs, central banks can fine-tune their policies with greater precision and accuracy, leading to more effective economic management. The rapid rise of private cryptocurrencies, such as Bitcoin and Ethereum, has raised concerns about their potential impact on financial stability and consumer protection. CBDCs could provide a safe and regulated alternative, reducing potential risks posed by unregulated cryptocurrencies. By offering a trustworthy digital currency option, central banks aim to mitigate the risks associated with private cryptocurrencies while maintaining control over the financial system. While the promise of CBDCs is captivating, they also come with a set of challenges and concerns that require careful consideration and planning by central banks. Ensuring user privacy while preventing illicit activities and cyber threats is a delicate balance that central banks must strike. Striking a balance between user anonymity and the need to monitor transactions for regulatory compliance can be challenging. Central banks must implement robust security measures to safeguard users' funds and protect against potential cyber attacks. Introducing CBDCs could have far-reaching implications for the stability of traditional banks and the overall financial system. A sudden shift in consumer behavior towards CBDCs could disrupt banks' deposit funding and lending operations. Central banks need to carefully manage the potential impact of CBDC adoption on the banking sector to maintain overall financial stability. Developing and maintaining the necessary technological infrastructure for CBDCs requires significant investments and expertise. Central banks must ensure the scalability, resilience, and security of CBDC systems to avoid potential vulnerabilities. Additionally, interoperability between different CBDC systems is crucial for cross-border transactions and global financial integration. Implementing CBDCs for cross-border payments involves navigating complex regulatory frameworks and fostering international cooperation among central banks. Standardizing regulatory guidelines and addressing legal challenges will be vital to ensure the smooth integration of CBDCs into the global financial system. One of the most significant questions surrounding CBDCs is how they will impact traditional banking. As consumers can directly hold and transact with CBDCs, it may change the role of banks as intermediaries and raise questions about their relevance in the future financial landscape. Traditional banks could face both opportunities and challenges with the introduction of CBDCs. On one hand, CBDCs could provide banks with new digital business models and enhance their payment services. By leveraging the benefits of CBDCs, banks could streamline their operations, offer innovative financial products, and improve customer experience. On the other hand, if consumers widely adopt CBDCs, banks may experience a reduction in traditional deposit funding, impacting their lending and profitability models. Banks might need to rethink their business strategies and adapt to the changing dynamics of the financial industry. To adapt to the changing landscape, traditional banks may need to invest in new technologies and explore partnerships with central banks or fintech companies to remain competitive. Central banks worldwide are actively exploring CBDCs through various experimentation and pilot projects. These pilot projects are essential in gaining insights into the practical applications of CBDCs, understanding user behavior, and addressing potential challenges before full-scale implementation. One of the most prominent CBDC initiatives is China's Digital Currency Electronic Payment (DCEP) project. The People's Bank of China (PBOC) has been conducting extensive trials of the digital yuan, with pilot programs in several cities across the country. The DCEP project aims to create a digital version of the Chinese yuan and explore its use in various scenarios, including retail and wholesale transactions. Similarly, the Eastern Caribbean Central Bank (ECCB) has launched a pilot project called dCash, which aims to improve financial inclusion and modernize the payment system in the Eastern Caribbean Currency Union (ECCU) member states. The dCash project is an example of how CBDCs can be used to address specific regional challenges and promote financial inclusion. The future of CBDCs is still uncertain, but there are several potential developments that could shape their evolution. Achieving global adoption and interoperability between different CBDC systems will be critical for cross-border transactions and global financial integration. CBDCs could also be integrated with smart contract capabilities, enabling automated and programmable financial transactions. This integration could further boost the development of decentralized finance (DeFi) applications. Thank you for joining us in this exploration of CBDCs. If you enjoyed this video, hit that like button and don't forget to subscribe to our channel for more exciting content.